Welcome to our channel. Today we're diving into the investment wisdom of Warren Buffett, one of the most successful investors of all time. We're going to break down his strategies into actionable steps that you can use to invest your first $10,000 or even just your next 100. If you're ready to start building long-term wealth and making your money work for you, you're in the right place. Let's get started. All right, let's talk index funds. These financial tools have become incredibly popular over the years, and for good reason. Warren Buffett loves these things, and for good reason. He's often praised them as one of the best investment options for the average person. You see, most people trying to pick individual stocks actually lose money. They're basically trying to beat the market, which is incredibly difficult. The stock market is unpredictable, and even seasoned investors can struggle to make the right picks consistently. Buffett knows this, so he recommends index funds, especially ones that track the S&P 500. This index includes a diverse range of companies, making it a safer bet for long-term growth. Think of an index fund like a basket of stocks. In the case of the S&P 500, you're investing in 500 of the largest US companies. This means you own a small piece of each company, from tech giants to healthcare leaders. This diversification is key because it spreads your risk across hundreds of companies instead of just putting all your eggs in one basket. If one company underperforms, it's balanced out by others that might be doing well. Plus, index funds tend to have really low fees, which means more of your money is actually working for you. High fees can eat into your returns, but with index funds, you keep more of what you earn. So if you're just starting out, investing in a low-cost S&P 500 index fund is a fantastic way to dip your toes into the market. It's a simple, effective strategy that even seasoned investors like Buffett endorse. By following this approach, you can build a solid foundation for your financial future without the stress of picking individual stocks. Remember, investing is a marathon, not a sprint. Patience and consistency are your best allies. And with the wisdom of Warren Buffett guiding you, you're already on the right path. Now let's talk about time horizon. Time horizon is the length of time over which an investment is expected to be held before it is liquidated. It's a crucial concept in investing because it helps determine the level of risk you can take on. Warren Buffett isn't about that get-rich-quick scheme. He's all about slow and steady growth over the long term. He believes in the power of patience and the magic of compounding interest. His strategy is to buy quality companies and hold on to them for years, even decades. He's held on to some of his investments for decades, letting them compound and grow exponentially. This approach has made him one of the wealthiest individuals in the world. The key takeaway here is that time in the market beats timing the market. See, when you invest for the long term, you're not swayed by every little market dip or news headline. Market fluctuations are normal, and they shouldn't cause panic. Instead, long-term investors stay the course, knowing that these ups and downs are just part of the journey. You're not constantly buying and selling, which can eat into your returns with fees and taxes. Frequent trading can be costly and counterproductive. By holding onto your investments, you minimize these expenses and allow your money to grow more efficiently. Instead, you're riding out the ups and downs, knowing that over time, the market tends to go up. Historical data shows that despite short-term volatility, the stock market has a consistent upward trajectory over the long term. So, if you're investing your first $10,000, don't expect to double it overnight. Investing is not a sprint, it's a marathon. It requires discipline, patience, and a long-term perspective. Think of it as planting a seed that will grow into a mighty oak tree. It just takes time and patience. Just like a tree needs time to grow and flourish, your investments need time to mature and yield significant returns. So, stay patient and keep your eyes on the long-term goals. Here's a big one, guys. Debt. Specifically, high-interest debt like credit cards. Buffett hates it, and for good reason. Think of it this way, if you're paying 15%, 20%, or even higher interest rates on your credit card debt, it's going to be really hard to earn returns on your investments that can outpace that. It's like trying to run up a down escalator. So before you even think about investing, Buffett recommends paying down any high-interest debt you have. It's like giving yourself an instant return on your money because you're essentially avoiding those sky-high interest charges. Once that debt is gone, you can start investing with a clean slate and watch your money grow even faster. Alright, this next tip is all about understanding what you're investing in. Warren Buffett calls it the Circle of Competence, and it basically means sticking to industries and companies that you understand. You don't need to be an expert in everything, just focus on what you know. For example, if you're really into technology and you understand how tech companies make money, maybe you invest in tech stocks or ETFs, or if you're passionate about sustainable living, maybe you look into companies focused on renewable energy or eco-friendly products. The point is, when you understand the businesses you're investing in, you're more likely to make informed decisions and avoid costly mistakes. Chapter 5. Now let's talk about emotions, or rather, how to keep them out of your investments. Warren Buffett is all about staying rational and avoiding emotional decisions, even when the market is going crazy. It's easy to get caught up in the hype when everyone is buying and the market is soaring, but it's just as easy to panic and sell everything when the market takes a dip. The problem is, emotional investing can lead to some really bad decisions. You might buy high and sell low, which is the opposite of what you want to do. So, how do you stay calm when everyone else is losing their minds? Buffett recommends having a plan and sticking to it. Chapter 6. Let's talk about fees for a minute. They might seem small, but over time, fees can really eat into your returns. Think of it like this. Every dollar you pay in fees is a dollar that's not working for you. That's why Warren Buffett is a huge advocate for low-cost investments like index funds. He knows that over the long term, even a small difference in fees can make a big difference in your overall returns. So, when you're choosing investments, pay close attention to the expense ratios and any other fees involved. Remember, the goal is to keep as much of your money as possible working for you, and that means minimizing those pesky fees. Chapter 7. Alright, let's talk about dividends. Dividends are a crucial aspect of investing that can significantly impact your financial growth. When you invest in certain stocks or funds, you might receive dividends, which are basically payments made to shareholders from a company's profits. These payments can be a great source of passive income. Now you can choose to take those dividends as cash, or you can reinvest them back into the investment. Reinvesting can be a powerful strategy to grow your wealth over time. Guess what Warren Buffett recommends? You got it, reinvest those dividends. Buffett, one of the most successful investors of all time, believes in the power of compounding. Why? Because of the magic of compounding. Compounding is when your investment earnings generate their own earnings, creating a snowball effect of growth. When you reinvest your dividends, you're essentially buying more shares of the investment, which can then generate even more dividends in the future. This cycle can lead to exponential growth. It's like a snowball effect, and over time, it can really supercharge your returns. The longer you let your investments compound, the more powerful the effect becomes. So, if you're looking to maximize your long-term growth, consider reinvesting those dividends and let the power of compounding work its magic. By doing so, you can potentially achieve financial independence and secure a prosperous future. Outro. And there you have it. Warren Buffett's top 7 tips for investing your first $10,000. Remember, the key is to stay patient, keep costs low, and focus on the long term. Don't try to time the market or get caught up in risky investments. Stick with what you understand, avoid emotional decisions, and let the power of compounding work its magic. Investing doesn't have to be complicated. By following these simple principles, you can start building wealth and securing your financial future.